You invest in stocks that pay you dividends. Every time you get paid, you reinvest that money to buy more shares. Repeat this for years, and your dividends keep growing until one day you're earning enough to live on without lifting a finger. How does this all work? And more importantly, how can it help you bring in $5,000 each month? In this video, I'm going to share two strategies with you. One involves a single investment, and the other is a monthly commitment of $200 to help you hit that $5,000 goal. Make sure to stick around until the end, because I'll present a stock portfolio that could potentially triple your returns over time. So what is the dividend snowball effect? It's quite straightforward. When a company pays you dividends, you can take that money to buy more shares of their stock. These extra shares will lead to even larger dividend payments next time. This compounding effect makes your investment grow rapidly over time, similar to how a snowball gets bigger as it rolls down a hill. Instead of growing in a straight line, your returns accelerate, which is what we mean by exponential growth. The secret here is to be patient and keep reinvesting. Start by choosing companies that pay dividends, then relax and watch your dividends work to build your portfolio over time. Just like a snowball gathers size and speed, your investments will flourish too. But here's the truth. Grasping the concept is one thing, but turning it into action is another. Imagine standing at the top of a hill ready to push a snowball down. You know it can grow big, but how do you get it rolling? Let's dive into some practical strategies to set your dividend snowball in motion. These steps will help you take what you've learned and apply it, allowing your investments to start gaining momentum and grow into something significant over time. To kickstart your dividend snowball, the first step is to establish a monthly dividend goal. Remember, every investment journey is personal. While some folks aim for $2,000 each month, others might set their sights on $5,000. It's vital to evaluate your financial circumstances and determine what aligns with your aspirations. Setting a clear goal not only gives you direction, but also allows you to measure your progress and tweak your strategies as needed. Just ensure you're realistic about your timeline and the amount you can contribute. Once your goal is set, the next step is to identify the type of returns you need from your stock investments. If you're looking to generate $5,000 in monthly income after retirement, focus on selecting stocks that provide a mix of high dividend yields, reliable dividend growth, and consistent share price increases. These three components work hand in hand to amplify the compounding effect, laying a solid foundation for your investment growth. With thoughtful choices, you'll be well on your way to achieving your financial dreams. Now, let's explore two strategies that can help you reach your dividend goal. Strategy 1. Meet David, who decides to make a one-time investment of $110,000. He puts down $10,000 into a stock that ticks all the right boxes. It has an 8% current dividend yield, a 7% dividend growth rate, and an annual share price appreciation of 6%. These factors will work in harmony to boost David's investment and dividend income over time. Here's how it unfolds. After 1 year, David's $10,000 investment grows by $1,400. Fast forward to 10 years, and it's worth $38,220. In 20 years, it balloons to $158,200. By the 30-year mark, that initial $10,000 investment has skyrocketed to $710,000. Over these 3 decades, his dividends alone add up to $65,500, translating to about $442.12 per month, right on target. Now, let's switch gears. Instead of a one-time investment, David decides to contribute $200 each month into a similarly high-yield, high-growth stock. This strategy harnesses the power of consistent contributions and the compounding effect of dividends over time. Here's how David's monthly investments stack up. After 1 year, he has invested $2,400. After 10 years, his total investment grows to $47,548. In 20 years, it reaches $246,100. By the end of 30 years, David's investment would be worth $1,158,159, giving him around $881 per month. Pretty impressive, wouldn't you say? Remember, stick around because I'll reveal how to earn double or even triple that amount in dividends with a well-chosen stock portfolio. Now, it's clear that the second strategy yields better results than the first. Why is that? This approach thrives on the steady, consistent growth of your investments while capitalizing on market fluctuations by spreading your contributions over time. It's an excellent choice for anyone who may not have a hefty sum to invest up front, but is willing to commit to regular monthly contributions. With this strategy, you're setting yourself up for long-term success, regardless of your starting point. There's a significant challenge here. Finding a single stock that consistently delivers over 8% in dividends each year can be tough. In fact, I usually advise against investing in stocks with yields higher than 7%. Why? Because of something called the dividend trap. Many newer stocks lure investors in with eye-catching, high starting yields, but these companies often struggle in the long run, leading to losses instead of gains. But don't worry, I have a solution. To reach your $5,000 monthly dividend goal, you need a balanced approach that combines dividend yield, dividend growth, and share price appreciation. Here's the plan. In the next chapter, I'll guide you on how to build a diversified portfolio that balances high-yield stocks with growth potential. This strategy ensures not only stability, but also maximizes your returns. Let's dive into creating a portfolio designed to help you achieve that $5,000 a month in dividend income. It's vital to include a variety of high-yield investments to ensure you have the stability, growth, and consistent income you need. Let's build the ideal portfolio by focusing on 3 tiers of investments: Dividend Aristocrats or Kings, robust and stable dividend ETFs, and dividend-paying REITs. We'll begin with Dividend Aristocrats or Kings. These are companies renowned for their long-standing commitment to increasing dividends consistently, companies that have been boosting their payouts for at least 25 or even 50 years. Based on my research, here are some top picks in this category. First up is Cintas Corporation, boasting a current dividend yield of 7.8%. What really sets it apart, however, is its remarkable dividend growth rate of 21.5% and an impressive 10-year average share price appreciation of 27.07%. Other strong contenders include Abbott Laboratories and Bank of America. When we analyze these stocks collectively, we find an average current dividend yield of 1.78%, a dividend growth rate of 23.44%, and a 10-year average share price appreciation of 15.67%. These metrics create a solid foundation for your portfolio, providing both growth and income stability. Next, let's enrich our portfolio with strong and stable dividend ETFs. These funds enable you to invest in a variety of high-yielding stocks, offering both diversification and ease of management. Some excellent choices for dividend ETFs include the Vanguard Information Technology Index Fund ETF shares, the Schwab US Dividend Equity ETF, and the Vanguard Mid-Cap Index Fund ETF shares. When we average the metrics for these high-dividend ETFs, we find a current dividend yield of 1.87%, a dividend growth rate of 12.58%, and a 10-year average share price appreciation of 11.54%. Now, let's bring in dividend-paying REITs, real estate investment trusts. These trusts are required to distribute at least 90% of their income as dividends, making them an outstanding source of high yields. A prime example is American Tower Corporation, which boasts a current dividend yield of 3.34%, a dividend growth rate of 18.83%, and a 10-year average share price appreciation of 8.16%. Other notable REITs include CubSmarts and Rexford Industrial Realty. When we average the metrics for these dividend-paying REITs, we arrive at a current dividend yield of 3.91%, a dividend growth rate of 16.99%, and a 10-year average share price appreciation of 9.81%. These REITs significantly boost the high-yield aspect of our portfolio, enhancing both income and growth potential. Now, when we combine the metrics from all tiers, our portfolio averages out to a current dividend yield of 2.52%, a dividend growth rate of 17.67%, and a 10-year average share price appreciation of 12.34%. This balanced mix of stocks, ETFs, and REITs ensures that our portfolio is well diversified and primed for both income generation and capital appreciation. With our diversified portfolio in place, let's dive into the detailed projections to see how our investments can grow over time. I'll walk you through both the one-time investment strategy and the monthly contribution strategy to help determine which approach might work best. Let's begin with the first strategy, the one-time investment. Given the current dividend yield of 2.52%, a dividend growth rate of 17.67%, and a 10-year average share price appreciation of 12.34%, if David invests $10,000 in this portfolio, here's what happens. After 1 year, his investment would grow to approximately $1,486. Fast forward to 10 years, and it's worth about $42,450. By year 20, David's investment could swell to roughly $217,450. After 30 years, that initial $10,000 investment would explode to an astonishing $1,514,523, generating around $139,200 in annual dividends. That translates to a monthly income of about $1,585. Now, let's look at the total investments over 30 years. David starts with an initial investment of $10,000, and by the end of that period, he'll earn annual dividends, totaling $139,200. This impressive income would allow him to retire comfortably, bringing in around $11,600 each month, well above our goal. Now, let's break down the second strategy, the monthly contribution approach. Suppose David decides to invest $200 every month into this diversified portfolio. By the end of the first year, he would have contributed $2,400, and his investment would grow to about $3,048. Fast forward to the 10-year mark, and he would have invested a total of $24,000, but the value of his investment would balloon to around $89,650. At the 20-year mark, David's total contributions would amount to $57,600, and the portfolio's value would rise to approximately $350,000. By the end of 30 years, David would have invested $72,000. His portfolio would reach an impressive value of around $1,813,200, generating annual dividends of about $92,300, which translates to around $7,693 each month, hitting our target perfectly. The key takeaway here is that the monthly contribution strategy outshines the one-time investment strategy significantly. The compounding effect of consistent, regular investments leads to much higher returns over time. This means that a steady approach to investing, combined with the power of dividends, can help you reach your financial goals faster and more effectively. In conclusion, building a dividend snowball is all about patience, time, and having a solid plan. Whether you choose to make a one-time investment or commit to monthly contributions, the important thing is to focus on quality dividend-paying stocks and maintain a diversified portfolio. And remember, the sooner you start, the more time your investments have to grow and compound, ultimately helping you achieve your financial dreams.